Investors, welcome to Stock AI Insights. This is earnings analysis. I'm your AI analyst. Today, we're breaking down JD.com's Q3 2025 earnings, released on November 13th. And let me tell you, this report paints a fascinating picture, a core business that's an absolute powerhouse of profit, but it's funding a super aggressive and very costly expansion.
But first, the usual reminder. This content is purely for educational purposes and is definitely not investment advice. You know the drill, investing always involves risk.
So let's dive right in with our hook. The CEO, Sandy Zhu, dropped a pretty huge number. JD.com now has over 700 million annual active customers. I mean, that is a massive milestone. This user growth is a really bright spot. But as we're about to see, getting that kind of reach is coming at a pretty steep price. Okay, so that leads us straight into our first section, revenue analysis. The top-line number looks pretty good, but the real story here is where that growth is actually coming from. It's shifting.
The headline number? Well, it looks fantastic. We're talking a nearly 15% year-over-year jump in total net revenues, hitting 299.1 billion RMB. That's definitely outpacing the broader retail market, but you really have to look under the hood to see what's going on.
And this chart right here really shows that shift in JD's growth engines. Take a look. Their traditional electronics business, it grew just under 5%. The real action is happening somewhere else entirely. General merchandise is up almost 19%, and check this out. Services revenue just skyrocketed, up over 30%. This is no accident, folks. It's a very deliberate strategic pivot. And the CFO, Shan, he confirms it directly. He's pointing right at general merchandise and advertising as the future. And you can see why this transition is so important, right? It diversifies their revenue streams, and more importantly, these areas usually have much better margins than the super competitive electronic space.
Which brings us to what is, honestly, the most dramatic part of this entire earnings report, the profit analysis. I'm calling this one a tale of two segments, and you're about to see exactly why.
So here it is, the number that really sent a shockwave through the market. A consolidated non-GAAP operating margin of just 0.1%. Let that sink in. To put that in perspective, just a year ago, it was 5%. So the big question is, with revenues growing so strongly, where did all the profit go? Well, this table explains absolutely everything. Just look at the raw data. The core JD retail segment was a beast, generating 14.8 billion RMB in operating income. JD Logistics chipped in another 1.3 billion. But then you look at that new businesses line, a staggering loss of 15.7 billion RMB. And this slide, wow, it just brilliantly illustrates that core conflict. On one side, you have the profitable, super efficient core retail business, which not only grew, but actually expanded its own operating margin to 5.9%. But on the other side, you have this massive investment burn in new ventures. We're talking JD Food Delivery, Jingji, international expansion, that completely wiped out all those profits, and then some, at the group level. And again, the CFO is making it perfectly clear. This is a deliberate strategy. This isn't some operational screw-up. It is a conscious choice to sacrifice short-term profitability for what they hope will be long-term growth in new markets. They are pouring an incredible amount of money into these new ventures. You know, I like to think about this with a metaphor. Picture JD Retail as this powerful, reliable cash engine. It's just humming along, churning out billions. The company is taking all the fuel from that engine and pumping it into a brand new experimental rocket. That's the new businesses. The hope is that this rocket will eventually achieve its own orbit and unlock massive future growth. But right now, it's just burning a ton of fuel on the launch pad. So let's move on to our guidance analysis and see where this is all headed. This whole section is about the huge bet management is making on future synergies. The big question is, will that rocket ever actually reach orbit? And this really frames the central debate for investors perfectly, doesn't it? Are these massive investments a necessary bridge to JD.com's future as a diversified tech giant, or are they just an unsustainable drain on a very profitable present? Management's outlook, not surprisingly, is very confident. They're talking about continued market share gains in core retail, and they believe these new initiatives, like JD Food Delivery, will create this powerful synergistic ecosystem. They even specifically pointed out that the food delivery unit is scaling up with an improving financial model, which hints that maybe,
just maybe, that heavy cash burn might ease up over time. Wall Street's view, though, is a bit more balanced. Analysts absolutely see the potential here. I mean, the user growth is undeniable, and the market opportunities in things like food delivery and lower-tier cities are just huge. But, and it's a big but, they also point to the incredibly intense competition, the sheer scale of the cash burn we just saw, and of course, the significant execution risk. It's one thing to have a great plan, it's another thing entirely to actually win in these hyper-competitive markets. So, what's our analysis verdict? It's a simple but powerful summary of everything we've looked at today. A highly profitable core retail engine is funding an ambitious, high-risk expansion into new territories. That is the tale of two JDs, all in one sentence. And this all leaves us with the one crucial question for any investor looking at this company. How long can that cash engine keep funding the rocket before that rocket has to prove it can reach a stable orbit of profitability on its own? The answer to that is going to define JD.com's next chapter. Drop a 1 in the comments if you found this breakdown helpful, and we'll see you in the next one.